It's Coram and Harold Morris here with your option of the day. We're in a volatile market right now, but Harold, we're seeing chip stocks flex their strength, including Lam Research. So we're going to take a look at that for our trade idea today. So tell us why the thesis of this trade, why you have a bullish bent here on LRCX.
Well, just like you've just mentioned, that chip stocks and other technology stocks are doing very well in this market. So looking at LRCX, one of the things that attracted me to this stock is the moving averages. Not only is it in a base, but the moving averages, they're converging together. And when you see these moving averages converge like that, that serves as a strong support area. It can also be resistance, but in this case, it's support. So the LRCX is broken above that support today. So that's the reasoning and thesis behind this bullish trade here.
Great. And we also have it right around that round number at 500, bouncing off of those moving averages, as you mentioned, getting to its highest levels in a number of weeks as well here. And it has the wind at its back and on a couple of fronts. We're seeing chip sector strength, and this group, the semi-equipment group, is currently ranked 8 out of the 197 groups that IBD tracks. So if we're looking to make a bullish trade here, Harold, while managing our risk, defining our risk, what sort of strategy could we look to here?
So we're going to be looking at a bull put spread. So this is a bullish trade on the stock where we're basically protecting our downside there. So you can either go naked, either selling a put, but there's a lot of risk involved. I prefer what's called a risk defined trade, where I'm defining what my risk is, so I know upfront what I'm looking at as far as my risk.
Great. Okay, so now that we know what trade we're going with, how do we determine what expiration we're looking at? How far out should we go?
I typically like to start 45 to 60 days out. Okay, and that's so in that window there. So I like to give myself the gift of time. Want to make sure that this trade is going to work out.
Okay, so now that we know we're going to be looking about 45 to 60 days out, we choose our expiration there. So it looks like April 21st is the monthly contract that we're going to go with. Now we've got to figure out what strikes
Right, right.
to utilize.
We're going to go out to the April 21st expiration. I click on that. And again, we have calls on this side, puts on this side. I'm going to scroll down. And what I'm going to do is I like to start with look at the delta. So I like to go usually around a delta 30, somewhere in that range. So with the delta 30, it's a delta 33. That's close enough. So I'm going to sell this 475 strike. And you see that here in the trade setup. And then look how much that would cost if we were naked. But I want to add some protection to that. So I'm going to buy the 470 strike. This is going to give me protection. So I hold my shift key or my control key down and I click on that. And you can see now where the trade is. It's not going to cost us nearly as much money here. All right. And I'm going to change this so it matches some of my math here. So I'm going to change it to 155 here. So looking at the trade again, we're going to be selling the 475 strike, buying the 470. So let's take a look at the numbers here. Click on confirm and send. First thing I like to look at is our break even. So 473, I like when my break even is below the stock price. The stock is trading roughly at $500
Yeah,
right now. So I've got a lot of room to the downside just to break even. So I
yeah.
like seeing that. And then my max profit in this situation is always going to be the credit received and then our max loss here. All right, so let's take a look at let's take a look at two things. We're going to look at the probability of success with this trade, and we're going to see, okay, how much capital we want to put to work in this trade. So let me get back over here, and then I'm going to click on the side here, and I've got some notes set up here. All right, so probability of success. So probability of success is defined as this trade making at least 1 penny or more. All right, that's our probability. And the way we figure that out is we take the width of the spread, which is $5 here. So that's the width of the spread minus the credit received. So $1.55, that's going to give us 345. So this is our actual risk in the trade. Now, to determine the probability of success, what we do is we take that 345 divided by the width of the spread, which is $5, multiply by 100. That gives us 69%. I like when we get up to around 70, 69, or, in the mid 60s and higher as far as that probability of success. So if you like what you see here as far as a trade, how much money are we going to put to work in this stock here? So I just came up with, okay, I'm going to put $2,500 in this trade here. To determine the number of contracts, I just divide my capital, $2,500, divided by my actual risk, and that's going to give us 7.25. Well, 7 contracts. So let's adjust the numbers here. I'm going to raise that to 7, and then I'm going to go check out my numbers again. So again, we still have the same break even here, but you can see the max profit and the max loss. You can see the capital being used. It's roughly the same there. So that's the trade. And then we just go, and I'm going to execute this right now. I'm going to just send it off, and hopefully we'll get filled on it.
Awesome. Well, thank you so much for walking through that, Harold. And just one more question for you as we wrap up. And I think that's just to give a little bit more context of where we're getting that hypothetical $2,500 from. So that's the amount of capital in your portfolio that you're willing to risk on the trade, right?
Exactly.
But how does that fit within a total portfolio value? Is it 2.5% or so of the total portfolio that you would be risking on the trade? Is that how we should think about it?
Right. So anywhere between 2.5 to 5%. That's the range. You can go higher, you can go lower. That's all up to you. So this was assuming that you had a $50,000 account. So $2,500. That's 5% of the overall account. So if this trade just went totally bad, you risk just $2,500. You still have a lot more capital to put to work elsewhere.
Right. And so if your account size is smaller, you would be adjusting the numbers based on, that
So
portfolio risk.
Position sizing is extremely important, regardless of what market you're in, but especially in this market, as it's gotten more volatile, position size is extremely important.
Well said. Well, we're in such a volatile market environment right now, so using these defined risk strategies definitely makes sense. Harold, thank you so much for breaking that down for us today. And everyone, be sure to check out the new Options Trader app from IBD. You can download it from the Apple App Store today. Just search Options Trader IBD in the Apple App Store. Check it out and let us know what you think for options education and more trade ideas. Thanks for watching, everyone. We'll see you back here next time.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.